Hey everyone, and welcome back to the Automated Options Trading Podcast. I'm always excited to dive into new strategies, and today we're talking about one that's great for beginners, especially if you're looking for ways to earn some consistent income from options trading.
You bet.
We're going to be talking about the bull-put credit spread. And one of the things I think is really neat about this is that, once you understand it, you can actually automate it right in your brokerage account.
Yeah, for sure. It's great for traders who are kind of, I guess you could say, moderately bullish about a stock or an index. They're thinking that the price is going to hold steady, maybe even go up a little bit.
Okay, so this is making me curious. Can we break this down just a bit? What exactly is a bull put credit spread?
So a bull credit spread, it basically involves selling a put option at a higher strike price, but at the same time, you're buying another put option at a lower strike price.
Okay, so I get the selling and buying put options part, but help me understand why we're doing both at the same time.
So by selling the put option at that higher strike price, what you're doing is collecting a premium. Think of it like a fee. And by buying the put at that lower price, that's what creates that safety net for us and limits the risk.
Okay, so I'm with you so far. Now tell me, how does this all work to actually generate income?
Well, if the price of the underlying asset, that stock or whatever it is, stays above the higher strike price, the one we sold at,
Right.
By the time those options expire, we get to keep the entire premium as profit.
That's amazing. So give me an example here.
Okay, so let's say the S&P 500, the SPX, is trading at $5,500. And let's say we sell a put option with a strike price of, we'll keep it simple, $5,500. And at the same time, we'll buy a put at $5,490. If the SPX stays above $5,500 when everything expires, we get to keep that premium.
Got it.
So for example, let's say that premium was $5. Well, that $5 is pure profit.
Okay, so I think I'm getting this. We're basically saying, hey, we don't think SPX is going to drop below 5,500, and we actually get paid to take that bet.
Yeah.
But I have to ask, what happens if it does go to low $5,500?
That's where the whole defined risk part comes in. You already know the maximum you can possibly lose on the trade before you even put the trade on.
So you're saying that even in the worst case scenario, there's a limit. There's no chance of blowing up my whole account or something.
Exactly. And that's what makes this so great for new options traders, a really attractive way to start.
This is all making a lot of sense, but can you walk me through those key components again? I want to make sure everyone listening is really clear on what's happening. I'm talking about the short put, long put, the strike prices, expiration dates, all that good stuff.
Of course. So the short put is the option that we're selling at that higher strike price, and that's where we get the premium income from. And then the long put, that's the one we buy at the lower price. That's our safety net.
Got it. That makes sense. And how do we choose those strike prices? What's the thinking there?
So a lot of times, traders will choose a strike price that's at or even a little below the current stock price just to create a cushion. The wider that gap is between your two strike prices, the higher your potential profit could be. But keep in mind, the higher the risk, too.
It's always that balance, right?
Yeah,
Risk versus reward. Okay, so then what about picking the right expiration date? How do we factor that in?
Expiration dates are definitely key. When you have a shorter expiration, that means less wiggle room. It's got to happen fast. Whereas longer expirations usually have less volatility, and that just gives the trade more time to work in our favor.
Okay, so we've got a pretty good grasp on what a bull put credit spread is, all those different parts. But now I'm curious about strategy. When would be a good time to actually use this?
Well, like I said before, it's best if you have that kind of moderately bullish outlook on whatever asset you're looking at. You're expecting it to either stay pretty stable or maybe even rise in price.
Okay, so let's talk about risk management for a minute, because let's be honest, I think a lot of new traders get nervous about that. What should they keep in mind?
The awesome thing about this strategy is it's like built-in risk management. You already know your maximum loss, but there are definitely things you can do to be even safer.
Okay, like what? Tell me more.
Position sizing is huge. Don't risk too much of your money on a single trade.
Don't put all your eggs in one basket.
You got it. A good rule of thumb is to risk 1 to 5% of your account on any given trade. So, for example, if you've got a $100,000 account, you wouldn't want to risk more than $1,000 to $5,000 on any single spread.
Okay, so let me just confirm, because that sounds pretty good. I could risk, say, 5% and potentially make a 10% return each month on a trade.
That's the idea. And some people even risk more, like 10%, hoping to make 20%. But the important thing is to figure out what risk level you're comfortable with, what matches your goals.
Yeah, that makes sense. You had mentioned earlier that this involves fewer commissions than other options strategies. Can you unpack that a little for me?
Well, with the bull put credit spread, you're really only putting on one trade each month. And some other option strategies,
Yeah.
you're in and out, and those fees can really add up.
So fewer trades means fewer commissions. It's more cost effective.
Exactly.
Okay, I like that. Now, let's shift gears a bit and talk about the profit potential and the break-even point.
Okay, so the max profit you can get with a bull put credit spread is capped. It's that premium that you got when you open the trade.
So if I get, say, a $500 premium, that's it. That's all I can make.
Right, your profit's capped. But hey, that profit comes when the underlying asset stays above that higher strike price.
Gotcha. So how do we figure out that break-even point?
So the break-even point is basically where you neither make nor lose money. And you can figure that out by taking the higher strike price and then you subtract the premium.
So if we think back to that example, our strike price was $5,500. We get a $5 premium. So that means my break-even point would be $5,495.
You got it. As long as that asset stays above $5,495 by the time everything expires, you're at least breaking even or making some profit.
This is all super helpful. We've gone over the mechanics of the bull book, the credit spread, talked about risk management. But can we make this real? Can you give me a real-world example?
Sure. Let's stick with the SPX, our example from earlier. And let's say we're using a service that suggests these spreads, like, for example, the monthly trend service. They've got a pretty impressive track record, over 11 years and a 55% win rate.
So over half their trades are profitable. That's pretty compelling.
And that risk-to-reward ratio, usually about 1 to 2, meaning every dollar you risk, you could make 2 in profit.
Okay, now I'm really interested. How does this service actually go about picking those trades?
They basically use options and really focus on those long-term trends, monthly trends of the SPX. You know, if you look at a monthly chart of the SPX over the years, it's more up than down, right?
So they're kind of riding that historical upward trend to consistently profit.
Exactly.
And you said we could actually automate the bull put credit spread.
A lot of services will actually let you automate the whole strategy right in your brokerage account.
So it's all hands off. The trades just happen.
Well, you still want to understand the strategy and, make sure you're managing your risk, but it definitely can make things easier. And you can potentially build some passive income.
So it sounds like this is a good way to, I guess, dip my toes in the water with options trading. But we always say there's no magic formula to get rich quick, right?
Absolutely not. There's always some risk involved. But the bull put credit spread, I think, is a fantastic way to potentially get income with that defined level of risk, which is great, especially for newer traders.
So no get rich quick scheme, but a way to maybe build some wealth over time.
100%. And remember, the more you practice, the better you get.
Okay, so even if I'm using a service like that, it's still on me to learn how it works.
Yeah.
I can't just take their word for it.
Knowledge is power, right? Especially when it comes to investing. The more you understand, the better your decisions are going to be.
I couldn't agree more. So if somebody is just getting started and wants to learn more about bull put credit spreads, where should they go? What do you recommend?
There are so many resources. I'd start with some good financial websites. There's a ton of info out there. And most of the brokerage platforms actually have free educational materials just for their clients.
And of course, podcasts like ours, we're here to help.
Exactly.
So to wrap this up, it sounds like the bull put credit spread is a really useful tool for any options trader, from beginner to expert. But especially, it seems like, for those just starting out.
I agree. It's a fantastic way to potentially create some consistent income, manage your risk at the same time. But like with any investment strategy, you've got to do your research, be thoughtful about it.
I think that's a great point to end on. Thank you so much for coming on the show and sharing your knowledge with us today.
Thanks for having me. I appreciate it.
And to our listeners, thank you for tuning in. We'll see you on the next episode. If you enjoyed this episode and want to stay ahead with fresh insights every other day, don't forget to hit that subscribe button or follow our podcast. We've got more exciting content coming your way, and we can't wait to have you back. See you soon.